And a sip of coffee.
Yeah, you gotta have a sip of coffee, take a deep breath. I didn't do my yoga this morning, so I'm a little light on my my Zen
Yeah, my
flow.
daughter needs to force me to do yoga more. And then let me
That's
just,
cool. So JP, what I thought we'd talk about today, because you sent me some really cool reports, I thought we would talk about like just the, like you said, the current environment, what's working, but maybe start off a little bit with, research. Why are we talking about research? We're talking about research mainly so that we can really have more profitable investments. And I want to talk a little bit about the value versus price thing, because what we're going to be talking about is more fundamental
Mhm.
factors. And I want to talk a little bit about that theory. I was doing some thinking about that, and then we can go through your reports about the current environment, and then maybe we can end up on some specific stocks that are kind of working. Maybe if that's okay, start off
Yeah,
that way.
yeah. No, I think that's a good way to approach it. I
Yeah, I mean, go ahead.
no, please go ahead.
No, I was just going to say, before I got your research, I was thinking about, what in our last conversation we were talking about value and not just necessarily value, but fundamentals. Like you asked me the question, what value does fundamentals bring? And that got me thinking really hard about that. And then after I got your data, I also, it was amazing because the data that you sent me fit right into what I was thinking. And what I started thinking about was, we learn in finance that value is what we should pay for an investment is a function of the present value of the cash flows. That's like ingrained in your head, and that makes total sense. There's all these different models and how you can come to that. And then I started thinking about what happens in real life, and many companies go bankrupt. They ultimately go to zero. They may earn some money on the way, and then but many of them go to zero. Some get bought out, and if the markets were perfectly efficient, it would have forecast all that in, right? It would basically. And we know that that's not true. We know that's not true. In fact, I did a little graph that showed I was mapping it out in my mind. You buy it at a certain price, and then, a stock can go up quite a bit before it actually ultimately goes to zero. Now, if your time horizon is infinity, then you would just say it's going to zero, and I'm not going to do anything about it, right? I'm not going to invest in that. If you were, let's say you had perfect foresight, you just say, no, I'm not going to do it. I mean, perfect foresight about the ultimate value. But there may have been some cash flows in between, so that has to offset it. So I'm like, okay, so that's kind of theoretical. What in the real world does that mean in terms of value? And I started thinking about what are the biggest factors that determine value, really do determine value as a business owner of a stock. And I came up with 6 most important things. One was the top line growth, how much they're earning and how fast they're growing on the top line. And then secondly would be how much do they keep that? Like what's the profitability of that? And then there's I called it capital intensity, but I'll go with what you have in your reports called capital efficiency. There's a ton of ways of looking at capital efficiency. In fact, when I broke it down and categorized it, I saw that many of the factors that were doing well were just some derivative of capital efficiency. Like, for
Mhm.
example, ROE versus acquisition. And so that's the other thing, is how effective they are with capital. And then the other would be the variability of that business or risk. And then the competitive advantage period, which is actually one of the most important parts of value. How long does this thing last? And then the last thing would be the cost of capital. All those things associated with debt to equity mixes and blah, blah, blah. How much does it cost me to have capital? To me, I would say 99% of value is in those somewhere. And I had this thought down, this list down on paper before I got your report. And then I get this beautiful report from you, which I thought was amazing. And I marked it all up. And what was interesting is that the stuff that's working all fits. I'm circling all these things. And I've talked a lot already. I want to shift it over to you now. And tell me what your take is, and whatever it is that you wanted to share with regard to your reports. Shoot,
Yeah.
tell me about that. What are your thoughts on that?
I mean, I feel like just saying amen and be done, because what you said is the gospel of fundamental analysis and valuation, right? I mean, what you highlighted are the drivers of value. And I think what's interesting when you look at these reports, when we look at these factors in aggregate, is we see what the market is valuing. You said, well, something that can go up and come back down. What is driving that is the market's perception or opinion of what's going to happen to these variables, right? We only know what we know, and that is what is priced in. So I always call it figure out what's baked in the cake, right? So what kind of set of assumptions are being currently included into the price, and that is what you're basically paying. This is the market price is a reflection of these expectations. And your job, or our job as analysts, is to figure out, well, do we agree or disagree with the current consensus that's baked in the price, right? Regarding growth, regarding the directions of margins, regarding the capital required to support that growth, right? CapEx and all these things, as well as the discount rate. And that varying view is how you make money as an active manager, right? So as an active manager, you only make money if you have a varying view in the market on either the magnitude or the direction of change of any of these drivers. Okay, so
I'm going to want to circle back to that. I'm going to want to circle back to that. That's a really good point.
Yeah. So so given that, what's important to understand, and getting back to those factor reports, is to keep an eye on what is working. The market does not reward the same characteristics of firms at different times. Like, for example, I think what's happened since the beginning of the year is absolutely baffling, right? We have seen, of course, let's be clear, it's been a momentum-driven market for the past 10 years. Basically, momentum has been everything. It's been the style that's been dominating every other style of investing. You just had to buy the same 5 or 6 companies, and you would have done exceedingly well because the same companies kept doing well. So there was a self-reinforcing mechanism at play in the market there. What happened then? We hit, the COVID crisis, which was at the same time maybe exacerbated and created a bit of a recession. And what we found in March, if you look at the factors, and we'll share those numbers, is now you're starting to see the market shifting their attention to things like earnings quality, right? So some of the best performing factors in March of this year were things like net income stability, net profit margins, long-term growth. So those were characteristics of quality that had been neglected in the past. Really, the market did not pay attention to that. I'm not going to say that it's reminiscent of 99, 2000, but it kind of rhymes a little bit, right? That we've seen a lowering of I would say, quality of analysis, right? So we saw that huge resurgence into those characteristics in March. And then, interestingly enough, it seems like the market became complacent relatively quickly, because as you move into April, May, and June, you're seeing again those themes of momentum coming back to the top, and the value and quality characteristics, kind of falling back as secondary drivers of market returns. So this is kind of maybe the setup that I've seen so far year to date. And I don't know if you have any thoughts or other observation on that.
No, I agree with that. Well, the thoughts I had was that the overall theme, if you look at the year-to-date numbers, is very clear. It's a bifurcation between the desire for an investment that is going to do okay and hold up in a bad economy, and finding those companies that have strong change that is positive growth. It's one of the two. So if you break it down to concerns over the economy, like you had mentioned, it's stability of net income, higher profitability related to capital, like capital efficiency type ratios, including return on capital, capital acquisition ratio, ROE, sustainable growth rate, all those things related to capital, which basically is saying that I have enough cushion, I have enough profitability and a cushion so that I'm not going to just get really whacked, strong balance sheets, and I'm not going to get whacked in a bad economy. Lower debt ratios have been, showing better things. So that's all, to me, kind of bundled, packaged in a nice little bow, saying I'm worried about the economy. And then the second part, that's what also says I'm worried about the economy, is you have things like SUI, surprise in unexpected earnings, which is kind of the variance of the earnings divided by the standard deviation of the earnings, that kind of a concept, and analyst expectation. So the market is trying to focus in on, hey, who's still going to do well, much like how we are. In fact, we are doing the same thing. Who's going to do well regardless of what's going on here? The key thing about this is it's a bifurcation, because the overall market is masking a lot of bad things going bad for a lot of companies. And you can see that we talked about this in our last video, the spread between the market cap weighted indexes versus the equal weighted is an indication of that. And of course, all the technicians are very aware of that, because we have all sorts of what's called diffusion indicators that are actually more precisely, I believe, measure that. And so we know that that's what's going on right now. And then if you look at it from a valuation standpoint, I almost kind of want to shy away a little bit from just like your traditional value right now, just because I think it's going to muddy our discussion a little bit. Maybe we can come back to it. But one of the things I was going to just ask you a question about and see what your thoughts was so I read this research paper called Fundamentally Momentum is Fundamental. And this is something that you've talked about before, but it was written by, it's called Fundamentally Momentum is Fundamental Momentum, written by Robert Novi Marx. Brilliant article, brilliant white paper. And they did an analysis on momentum, and they showed that momentum has twice the Sharpe ratio, not just recently, but over a long period of time, twice the Sharpe ratio of value and size, which is what academics tend to focus in on. And they also show that SUE, that relationship with earnings expectations. Did we beat expectations or not? They're very closely related. In other words, momentum is discounting in better than expected numbers. Very brilliantly written article. But one thing he points out is that momentum itself has these big crashes. There's another article called Momentum Crashes by Kent Daniel, Tobias Moskowitz. And what they showed is that volatility sizing, which is a lot of what we do, actually improves momentum strategies dramatically. And I want to hear what your thoughts are on that. I mean, you showed me a volatility chart, and I'll bring that volatility chart up.
Maybe before you show it, I'll say that. So volatility as a pure style has been a losing proposition. So it makes sense that investors have not been rewarded for carrying just volatility to get exposure to beta or volatility, however you measure it, right? So, I'm a firm believer that you should only take risk for which you expect to be compensated, and by compensation we mean excess return, right? So what you're saying makes a lot of sense. So we're trying to find that pocket of stocks that give you again the best risk-adjusted return. We go back to that very basic theme here, but we so what we are seeing here is that we have a you have to look at how does the risk and return trade-off play out in the market, right? So if you have, for example, you said we're going to go back to maybe this value momentum thing, but maybe it's worth introducing, what's going on right now is if you look at value versus momentum, like a pure value style, like I'm a value guy and I want to invest in cheap companies, very basically defined as, cheap PE or cheap price to book or something like that, versus focusing on price momentum. Well, the wedge, the difference between these two styles is as wide as it's ever been. Basically, if you're a pure value, you would have not gone anywhere for almost 20 years, at least the past 10 years, which is which is, a very long time for something to be out of favor. So since 2005, really, it's been a round trip. I'm looking at the chart here. While momentum is up about, more than 100% over that same period. So,
are you looking at the return spread charts? I can plop.
Yeah, I'm looking at the return spread. So if we look at the pure performance of those things,
I mean, that's a crazy looking chart, right? I mean, the value is it just doesn't make sense, right? This makes no sense to me.
It doesn't make sense. And the question, I can ask you is, do you think value is dead? And that was a question I'd like to pose back to you, because there's a lot of people, and sometimes you see headlines in the media saying, well, people are saying value is dead and it will never come back. I would say I'm not willing to go to the funeral yet. I'm not ready to bury value yet.
No, actually, I think what we're going to be experiencing a resurrection, not a death.
I know it's going to rise again.
Yeah. It's just a matter of time. We're seeing the beginning, tiny phases of that technically. That's why I'm watching the technicals so much on these stocks. I think that I don't believe value is dead.
It is not dead, but there's times to be in it. Like, for example, we've seen it after 2000, 2001. There was a huge boom in value. We've seen the same thing in 2009 after. If we believe that we are in that same, we've seen the bottom in Q2, then maybe now is the time to look at value. But again, value as a pure play comes with, to go back to our original point, too much risk. Like, you have to carry too much risk to go into that category of stock. So you need to combine it, in our view, with other things. Like we mentioned, quality. For us, it's the foundation of what we do. If a company doesn't have the basic quality that we're looking for, balance sheet, earnings, and profitability and capital efficiency, it just won't move forward, right? We don't do value for value. I'm not looking to buy $1 for 50 cents. I'm looking to basically buy a great company at a reasonable price, right?
Especially if you hold it longer.
Exactly.
You might have a rebound from a cyclical company that lasts a year and a half, maybe, and then it just flatlines. But you're not going to get like a multi-cycle growth pattern in those stocks usually. You might get the inflation rate with a lot of volatility, but
yeah.
Well, I agree with that. I don't believe value is dead, and I think there's that old saying that value and growth are connected at the hip, kind of a thing. When I look at the value chart, I think if I had to guess what the sequence of events is going to be with value stocks, it would be that we go into a recession and those value stocks get worse. And then when we come out of it, they kick the pants out of the momentum. That the momentum doesn't do as well. And that's based on some research I did on the last 3 cycles that showed that the dispersion of returns in the value stocks are much wider, but it has a bigger positive expectancy when you're coming out of the recession. Mm-hmm. And that has to do with the fact that many of these companies that are beaten down, there's concern about the viability of their balance sheets. There's concern about like how well this company's going to literally survive, especially those that have a lot of capital intensity. But those companies that do survive, they tend to do a bit of catching up, quite a bit of catching up, and that will supersede the performance of the not all, but many of the high relative strength companies. But the ones that tend to break out, the ones that are hitting highs first, that are in the value bucket, have a lower, a more tight distribution of return patterns coming out of a recession. So I think that's why you have to look at these technicals. It's not a panacea, and I really think that the concept of technical analysis is really a form of fundamental analysis that's actually done in reverse. There's some validity to that, because not everything is recognized. By the time we get those quarterly numbers, it's the market's already discounted a ton.
Yeah, I'd like to, we talked about value, but maybe I'm saying something a different way, but I like to call it's really mispriced growth, which sounds like a small difference, but there's a big difference in that statement. It's not something that's cheap for being cheap. It's basically the fact that the growth expectations, again, are not recognized by the market. And this is where supplementing with technical analysis, you are seeing when the market is starting to recognize that. And this morning, just before this call, I was going crazy looking at stocks. We have a little bit of dry powder right now to deploy. The market action in the past couple of days has been very interesting. We had a huge sell-off on Monday on basically the momentum stocks, the things that have done great, your Amazon, your Netflix, those things sold off big, and there's a bit of continuation. And ever since yesterday and continuing today, we have companies like the Dow Jones really outperforming by double the NASDAQ and even the S&P 500. So those are the more cyclical, industrial, old companies. So, and I'm looking at this, and the technicals are looking great. So I was going crazy looking at materials and industrial companies today. Even some energy seems to show some signs of life. So this is all like what you would call the value bucket right now in the market. And you look at it, and there's great companies out there that will have a huge rebound if we follow the current path of the economic recovery. And right now, because of the recent performance, the market is not liking that. Again, we were valuing those companies that were resilient in this environment, right? And now we're going to maybe willing to say, okay, these companies will not go out of business, like you said, they won't. They will come back, and maybe right now they're actually trading at very attractive valuation for the business that you're getting. So again, it's all about, we can actually upgrade the portfolio again, from take some profits and reinvest into some great businesses for the next cycle.
Maybe. I'm wondering if that's early still, and I'll tell you why. So you said something that really threw me off, only just because it's so different than my mindset right now, which is great, because that's how you get to the truth, right? Having a difference of opinion and talking about it. Because on one hand, you could say we had a recession, right? Because we had a big, fast drawdown in higher unemployment and all of that, due to the pandemic. But this is so different. This is, like, to me, more of an exogenous shock than it is a typical recession. And that's one of the reasons why I think it's moved back quite aggressively. And we're in an election year, and my thinking right now is we're in an election year, and I'm kind of disregarding that decline as being a traditional recession. Like, I'm not so sure that we've actually hit the recession, if that makes sense. In other words, what we saw was just the beginning of a topple. And I think it's very path dependent and conditionally dependent. And it has to do with what happens from here. If we have more, California just decided they're going to shut a bunch of stuff down. We're talking about schools going back, who's going to go back to school, who's not going to go back to school. In prior videos, you mentioned the concept of second and third order implications of this. And I think we have not really fully explored number 2 and number 3, and so it could go one or two ways. It can go in multiple different ways, but one way would be the second order implications are worse than we thought, and then we go into more of a real recession, if you will, which means real estate prices start getting hit. The Fed is even more, it's a lot worse than we're looking at right now. The other scenario could be that we go into election year and it just continue to go higher, and that we never, and that was it. That was the recession. Now we're going to go to another cyclical boom kind of a thing. I have a little bit hard time. I think primarily we did not see the traditional, because the cause of the decline was not your typical cause, and we saw a very quick snapback. I'm not so sure that that's the case, that's what's going on here. And I think a lot of it has to do, we haven't even hit the winter yet, right? Now, some people are saying, hey, look, this pandemic's going to go away after the election. Those people are very skeptical of anything that anybody says in the media. I would not go that far at all. Others are saying, smart people who are, biochemists and doctors, they're saying, look, if you start looking at the data, how this thing spreads, you put a bunch of kids back into school and they're within 6 feet of each other, they're in the same room for over hours at a time. It only takes one student, and the amount of penetration, the amount of spreading of this could be very dramatic. You can come home, then it becomes a problem. So some people think we're playing with fire with this whole thing, with this going into the school season. So I think it's really, and I hate to say this, but I do believe that it is driven by what numbers we see in COVID and how our governors respond, how the state responds. That's not so much the federal government, but how the state responds, because that's going to actually affect what happens in those economies state by state. So that's one reason. Now, if that's the case, these stocks that are more value oriented, in my opinion, they continue to underperform. If I'm wrong, if that's wrong, and we go into the other scenario, I think these value stocks are going to just like rocket. Now, how do you know when to do one or the other? I think gosh, you're going to hate my answer, but I think you look at the technicals, because they'll start telling us that before it happens. Right now, I actually am leaning towards the fact that, or leaning towards the scenario that we are going to have a little more rockiness. But the charts are not saying that yet. But my logic, the logic in my head says that, but the market's not agreeing with me. So, and we're not changing the way we invest based on that. We're using our discipline, and we've been trimming back on stocks that have gone up a lot and that have hit our targets where we want to pare back. But we're not getting out of the market, because there's really no need. There's still opportunities. Like I said, there's still a lot of opportunities. But when you go back to the logic of it, I'm not so sure it was a typical recession. And so I've been talking a long time. It's your turn. What do you have to say about all that?
Yeah, no, I couldn't agree more that this is extremely path dependent right now. And we are, again, the playbook, or what's baked into the cake, again, in the market, the current market valuation and market performance is really that relatively V-shaped recovery, economic recovery. And but let's go back to the beginning of the year. I mean, we have been conservative in the portfolio since last summer, right? So we were expecting a slowdown. Of course, we didn't know what was going to trigger a recession. We got handed something that was unprecedented and definitely unexpected. That exacerbated, I think, what was already there. So you're right. What is always a struggle right now, and I think everybody is feeling it, especially when you look at the market every day, is this giant wedge between Main Street and Wall Street that everybody discusses, right? It doesn't feel right that the market is reaching new highs when people are still losing jobs. There's still millions of people threatened to be evicted from their apartments. There's still plenty of businesses that are, if there is a second shutdown, may not survive, so on and so forth. So there is a tremendous amount of like that real economy, which somehow will become, it's the economy, stupid, right? So it will translate into real numbers, right? And I believe the market is a bit complacent about that. So I could not agree more that the market, even with this recent week of constant bad increase in cases and shutdown, the market has not priced in anything, right? I mean, as far without some volatility, mostly due to earnings season, I don't think we've seen any pricing of additional risk or more probability of a second, really a second wave, and that gives me pause, right? So right now I'm going the playbook and said, okay, the market seems like it has discounted, Q1, Q2, Q3 probably, and said we're going back after the races as after Q4, and that's what makes whatever I was mentioning look attractive right now, because that's what seems to be the
so money will flow out of those stocks that have already rallied. This could be a rotational time right now, especially. Exactly. So that's the other scenario, and the charts are teeing that up right now all over the place.
Mm-hmm. No, it's been mind blowing. I mean, this rotation, and that's why we have to be careful. You and I have seen this, a number of times right now, and at market tops, there's no leadership, right? The leadership will change, we'll get into the chop, and it's very easy to get caught in that and get whipsawed, right? So you got to stay like, what are you looking for, and how do you invest in that environment? Because there is money to be made even if the market stays sideways for a long time, going nowhere, right? Actually, it's even a better environment for stock pickers when, just throwing a dart at it and writing it no longer works, right? So those are good environment, for
Yes.
stock picking and active management.
Yeah, absolutely. I agree with you 100%. So I was having a conversation with a investment manager who was talking about, he mentioned some statistics about the banks having a lot of liquidity. And so I got interested. I pulled up the ICI numbers, the Investment Company Institute numbers, and looked at the money market funds. The money market funds were up, I believe I calculated 38% from January, something like that. It was it's a big number. And then it's starting to come down as people are putting money back to work. But you know what? It is nowhere near where it was. So in other words, it came down, and then and I what I'm saying, it's starting to, the cash numbers went up, and now people are starting to put it back to work, but we have not gone back, not even close back to where they were. So there's still a lot of money sloshing around the system. We've got the Fed throwing money all over the place. We got, there's all sorts of stimulus money that's hitting the deposits, and that's going into consumption and into investment. I mean, you hear stories now of young millennials who are opening up Robinhood accounts and buying stock. I mean, this is what's happening right now. So we have a liquidity effect, and then it's almost like a three-legged stool. And one side you got the kind of the reality of it, and then the other side you got what is the supply and demand of the shares themselves, and that's navigating the gap between value and price. And so to me, I think your assumption sounds totally right. That what you're thinking sounds right to me. That we're going to have a rotation, and it may not, the amount of that rotation I'm not clear about. But the good news is our strategy helps us decide that as it's going. We don't have to have a perfect crystal ball. We decide it as it's happening, as the market proves itself out. But what we do know is that there's a lot of high quality companies with strong balance sheets, and their valuations are a little more reasonable now, that are also starting to tee themselves up. They're making big solid bases on the right side of those bases, and you're starting to see them move towards their highs, which is statistically is a good thing. So if that happens, you could see this NASDAQ relative to the S&P gap. You can see that gap close a little bit. I know what you're saying, right?
Yeah, that's what I'm saying. And I'm glad you mentioned it. And that's what I like about, we talked about scenarios, but when you build an actual DCF, a discounted cash flow model, to value a company, right? The beauty of a model is not, again, to get that intrinsic value. Like we said, this is not it's a target to try to determine if something seems to be overvalued or undervalued by the market based on your expectations. The value of a model of doing something like that is the ability to play scenarios, to do what if with those variables, and say, what if I'm wrong? What if it's this scenario, like everything goes well, but what is the worst case scenario? Because as we know, this is the one that we prepare for, right? This is the one we hope doesn't happen, but that's the one we prepare for, and that we have to know what is the downside. And it's very rational way. Like, it's not a question of emotion. It's not about how I feel about this company. It's about, okay, what's currently baked into the price and valuation, and then what do I think is going to happen, and what happens if I'm wrong? So how much margin of safety do we have in that stock? And right now, if you see something that has, that's what happens when things look cheap, is basically like you have more margin of safety. That basically means that you're closer to the worst case scenario valuation, then there's more upside than downside. And that's what we're looking for, is where there is a larger upside, right? Your reward to risk ratio is attractive, right? And I think that's what value gives us. It hands us over these opportunities that give us the right odds.
Yeah, so you can see something that's clear versus there's a lot of times when you do DCF, it's not clear. It's just kind of fuzzy. Like the price sort of looks like the price now, or you can make it easily look like the price now because everybody's doing this stuff. But as at the margin, when the fundamentals change, the price is changing.